If you want my honest answer, I would not wait until the panic starts to think about my bank. That is already too late. Most people think about the number inside the account. Very few think seriously about the institution holding it, the structure behind it, the fragility behind the smiling branch manager, the app on the phone, the quiet assumption that money sitting in a bank is simply safe because it has been there for a long time. That assumption has ruined people before. It will ruin people again. When I was younger, I learned something early about financial systems. They do not usually announce their weakness with dignity. They drift toward stress in plain sight while the public keeps talking about unrelated things. Stocks may still be near highs. Television may still sound cheerful. Politicians may still speak as if control is intact. The buildings still stand, the ATMs still work, people still swipe their cards. And underneath all that ordinary motion, the pressure keeps building. Then one day a thing the public thought was impossible becomes obvious. By then, it is never the best moment to act. That is why I want to speak plainly about cash banks, liquidity, and the uncomfortable difference between being insured on paper and being prepared in real life. A lot of people listening to this sort of conversation do something predictable. They assume the speaker is calling for drama. They imagine mattresses stuffed with bills, fear disguised as wisdom, a rejection of the entire banking system, some theatrical collapse story designed to provoke adrenaline. That is not what I believe in. I believe in structure. I believe in preparation. I believe in never putting yourself in a position where you need the system to behave perfectly at the exact moment the system is under strain. That is a very different philosophy from panic. Panic happens after the crowd notices. Preparation happens while most people are still comfortable enough to ignore the problem. The reason I care about this now is simple. Too many people still think the banking trouble we saw earlier in the decade was some isolated event, some peculiar accident caused by one badly managed institution, one unusual customer base, one unfortunate cluster of circumstances that will not repeat. That is how the public always prefers to understand danger. It wants the problem to be unique because a unique problem can be mentally sealed off. The reality is usually harsher. The visible failure is often only the first institution that could no longer hide a broader weakness. What breaks first is not always what is weakest in absolute terms. Sometimes it is simply what gets questioned first. That is how bank runs work. A bank can look respectable for years. It can report capital. It can show reassuring ratios. It can have a glossy website, a polished management team, and a customer base with no idea what is sitting behind the curtain. Then something changes. Interest rates move, bond prices fall, depositors begin asking harder questions. A concentrated set of customers starts pulling money. A rumor spreads faster than a balance sheet can defend itself, and suddenly the thing that was considered stable becomes dependent on time it no longer has. That is one of the oldest truths in finance. A bank does not need all depositors to lose confidence. It only needs enough of them to demand reality all at once. That is why I keep returning to a simple idea. A bank is not a vault in the way people imagine. It is an intermediary. Your money is not lying there politely waiting for you, in the same form you handed it over. It has been transformed into claims, loans, securities, reserves, and assumptions about normal behavior. That arrangement works beautifully until behavior stops being normal. Then the structure matters very quickly. Most depositors never study the structure because ordinary life does not demand that they do, so that is precisely why periods of financial strain are so dangerous. The public discovers late what should have been understood earlier. Now let me put this in more human terms. Years ago, I met a man who had spent his whole life doing what careful people are told to do. He worked, he saved, he avoided foolish speculation. He kept a substantial amount of money in bank accounts because safety meant familiarity to him. He did not trust markets very much. He trusted institutions, he liked statements, he liked insured products, he liked the feeling that his money was close, visible, and respectable. He was not stupid. He was disciplined in the way many decent people are disciplined. But discipline without structural understanding can still leave a person exposed. When rates moved and stress began showing up in parts of the banking system, he asked me a question I still remember. He said, If I am under the insured limit, am I fully safe? I told him that he was asking the right question the wrong way. Legally safe and practically prepared are not the same thing. If a single institution fails and the process moves smoothly, insurance can work as intended. But if multiple institutions come under pressure at once, if the public begins moving money broadly, if confidence has to be restored politically rather than mechanically, then the relevant question is no longer only whether a form says your deposits are protected. The relevant question becomes whether you can function calmly during the period between shock and resolution. That window matters more than most people think. People speak as if a bank problem is only about permanent loss. Sometimes the more immediate danger is temporary paralysis, access delays, transfer limits, weekend uncertainty, corporate payrolls frozen, business accounts disrupted, households suddenly unsure what they can reach on Monday morning. That kind of stress changes behavior fast. A person with obligations due in 3 days does not feel reassured by a theoretical promise that a process will be sorted out. Eventually, he needs usable liquidity, he needs room, he needs time that does not depend on official statements. That is why I have never believed the intelligent response is to either ignore banking risk or to abandon the system entirely. I prefer a middle path: use the system. Do not depend on it completely. That distinction matters, and it matters even more when several pressures begin arriving at the same time. One of those pressures is the simple arithmetic of rates. Banks loaded up on longer-dated securities when rates were far lower. That made sense at the time to people who believed the old world would continue. Then the old world changed. Rates rose faster than the comfortable assumptions built into many balance sheets. When rates rise, the market value of older bonds falls. That is not exotic. It is Finance 101. The problem is that when a bank is sitting on large unrealized losses and depositors remain calm, the problem can stay hidden in plain sight. If depositors stay put, the bank can pretend time will heal most things. If depositors do not stay put, paper losses become living stress. This is one reason I have such respect for liquidity. Liquidity is not merely cash, it is the ability to meet obligations without begging for understanding. It is the difference between being a spectator to stress and being its victim. Now layer onto that the issue people are still reluctant to face squarely: commercial real estate. I am not speaking about some glamorous trophy tower that becomes a newspaper story. I am talking about the huge, ordinary, heavily financed landscape of office buildings, mixed-use properties, refinancings, leases, vacancies, and loans sitting inside regional balance sheets. The public likes to separate one financial issue from another. The real world does not. If office demand remains structurally weaker, values remain under pressure. If values remain under pressure, refinancing becomes harder. If refinancing becomes harder, losses surface. If losses surface at institutions already dealing with bond marks and funding competition, the strain compounds. The dangerous thing in finance is not one problem. It is multiple problems arriving at the same institutions before confidence has time to recover. That is how slow unease turns into a run. And when I say run, do not picture a black and white movie with people lined up in hats outside a bank. Modern runs happen through phones, they happen through Treasury departments, they happen through wealthy customers transferring with one instruction. They happen faster than the old safeguards were, psychologically designed to process. That matters. People still think speed favors the regulators because the regulators are powerful. In truth, speed often favors fear, and fear has become much more efficient. There is another force in the background that few depositors think about when they look at a simple savings account. The federal government itself is absorbing an enormous amount of capital debt. On that scale is not an abstract political talking point. It affects funding markets, it affects rates, it affects what banks hold, it affects what investors demand, it affects the competition for savings. When the government must refinance and issue in large size year after year, somebody has to buy that debt. If foreign buyers are less enthusiastic and the central bank is less openly accommodating than in prior periods, then the burden shifts inward. The domestic financial system carries more of the weight that has consequences. A dollar that goes toward absorbing government borrowing is a dollar not doing something else in the private economy. Over time, that changes the texture of the whole system. It tightens quietly at first, then not so quietly at the same time. If the central bank is trying to drain liquidity or at least avoid flooding the system the way it once did, then banks, funds, and markets have to operate with less cushioning than people became accustomed to. That is why I do not judge financial conditions only by stock prices. Stock prices can stay cheerful longer than plumbing does. Plumbing is where strain shows up first. Repo markets, funding markets, credit spreads, regional banks, refinancing windows. Borrowers that suddenly cannot roll what everyone assumed they would roll without incident. By the time the public begins asking whether its bank is safe, many of the more sophisticated players have already been watching the pipes for quite a while. I do not say that to flatter sophistication. I say it because the ordinary depositor has to compensate by being a little more deliberate than he has been trained to be. So let me get practical. What do I think a sensible household should do before April 2026? First, understand the insurance limit, but do not stop your thinking there. If you have more than the insured amount at a single institution, that should be addressed. That is basic hygiene. Spread large balances across institutions where appropriate. Use legitimate structures that increase coverage where applicable. Move excess into direct short-term government obligations. If that suits your needs better, no drama. Just tidy the exposure. But the insurance limit is only the first layer. The second layer is more important. Build a reserve outside the banking system sufficient to cover several months of real life. Not symbolic cash, not a decorative emergency fund that would disappear after one bad repair and 2 mortgage payments. I am talking about 3 to 6 months of true living expenses, sized to the household honestly, not optimistically. If a family needs $5,000 a month to operate, that reserve is not $3,000 in good intentions. It is $15,000 to $30,000 in usable, dependable, non-bank access. If the family needs $12,000 a month, then the reserve should reflect that reality instead of pretending otherwise. This is where mature finance begins. Honest numbers, people understate their needs because the real figure makes them uncomfortable. Reality does not care. The reserve should be split intelligently. Some physical cash for immediate access, not absurd piles, enough to handle short interruptions, payment issues, and the first chaotic days of any institutional stress. Then short-dated Treasury bills held directly, not merely as a number inside a bank sweep structure. Direct ownership matters because the whole purpose is to reduce dependency on the intermediary layer. Then, for households that understand the role, some physical precious metals can make sense. Not because I expect gold coins to replace a checking account next Tuesday, but because precious metals are a form of insurance against a broader loss of confidence in paper promises. Gold has never needed permission from a bank manager to remain gold. I am not ideological about this. I simply know history. When systems come under strain, people rediscover the value of assets that are not someone else's liability that matters. The third layer is behavioral. Do not wait until an ugly headline to decide what your plan is. Write the plan now, which bank accounts are primary, which balances would move first, what amount remains at each institution, where the Treasury bill ladder sits, what is accessible immediately, what is accessible within days, what family members need to know where documents are stored, how bills get paid if one channel is interrupted. Prepared people look calmer because they have replaced vague worry with a sequence that matters more than the public appreciates. When stress arrives, confusion destroys intelligence. A written plan protects you from improvising while frightened. There's something else people misunderstand. Cash is not trash in an environment like this. That slogan only sounds clever in periods when risk assets are levitating and money costs nothing. When short-term government paper can pay a respectable yield, cash and near cash stop being dead weight. They become optionality with income. That is a wonderful combination. Optionality is one of the most undervalued assets in finance. The person with liquidity can wait, he can buy when others must sell, He can stay calm during institutional tremors. He can avoid converting temporary uncertainty into permanent damage. All of that is a return. Too many people judge returns only by what flashes on a screen in a bull market. I judge returns by what they let you survive and what they let you do when the environment changes. That is why if I thought the next year carried meaningful financial plumbing risk, I would be perfectly content holding a serious amount in short-term government paper and cash equivalents, provided I had structured them intelligently and not merely left everything inside one familiar bank. Familiarity is not a risk control system. People confuse the two all the time. Let me also say something uncomfortable. There is no large institution in America that becomes more trustworthy simply because its brand is old and its logo is polished. Large banks can be better diversified. They can be more systemically important. They can also be part of a system under stress. Do not reduce a structural question to a branding question. Ask what function an account serves. Transaction convenience, short-term liquidity, reserve capital investment holding. Once you define the function, you can place the money more intelligently. A transaction account needs convenience. A reserve account needs resilience. An investment account needs purpose. Too many households throw all three functions into one pile and call it simplicity. That is not simplicity. That is concentration disguised as convenience. The family I want you to imagine is not a billionaire family with 10 advisors. It is an ordinary, serious family that worked hard for what it has. Maybe both spouses worked for decades. Maybe one built a business. Maybe there is a retirement transition coming. Maybe they have aging parents, tuition worries, medical questions, and no appetite for discovering in real time how fast administrative systems move when multiple banks are under pressure. That family does not need heroics. It needs structure. That means transaction money here, reserve money there, direct Treasury exposure where appropriate, hard asset insurance in sensible size, and enough clarity that no one is improvising under duress. People will object that this sounds too cautious. Perhaps I have always found that being a little too cautious in preparation is far cheaper than being a little too trusting. When the pressure finally becomes visible, early caution costs some convenience. Late caution can cost access. Those are not comparable prices. There is another feature of crises people forget. The objective is not merely to avoid being hurt. The objective is to emerge positioned to benefit from what follows. Every serious financial break creates a transfer from the unprepared to the prepared, from the illiquid to the liquid, from the leveraged to the patient. If you have usable reserves outside vulnerable channels, if you have direct short-term government paper, if you have some hard asset insurance, if your household can function without begging the system to behave instantly, then a crisis becomes not only something to survive, but eventually something to use. That is how fortunes quietly advance after periods of fear. The crowd remembers the pain, the prepared remember the prices. I have seen this enough times that I do not romanticize panic and I do not underestimate it. During the decline, people say the world has changed forever. Perhaps it has in some ways, but the pricing of good assets often becomes absurdly attractive precisely when frightened people cannot act. That is why I care so much about reserves. Not merely to endure, to be able to choose. Choice is what fragility steals first. Now, if you want a blunt number, I would tell most households this. Before April 2026, I would want no less than 3 months of true expenses outside the ordinary banking channel. And in many cases, 6 months would be more intelligent. Some in physical cash, some in direct short-term Treasury obligations, some in hard asset insurance if the household understands the role. The exact number depends on life. Not everyone should withdraw the same amount because not everyone lives the same life. A single retiree with modest needs is not the same as a business owner with payroll, children, elderly parents, and multiple properties. A family with $4,000 in monthly expenses is not the same as one with $15,000. The correct number is the number that lets you remain calm if the normal channels seize up temporarily. Calm is the test. If the reserve would not let you remain calm, it is too small. This is one reason I dislike one-size-fits-all financial advice. It sounds democratic, and it is usually lazy. The right question is not what amount sounds dramatic in a headline. The right question is what amount makes your household independent of immediate institutional smoothness for long enough that the noise can pass. That is adult finance. There is another danger I want to protect you from. Do not turn caution into paranoia. The person who empties everything, breaks every relationship with the banking system, and begins living as if all institutions are fiction, usually creates a new set of problems. The system still needs to be used. Bills must be paid. Investments must be made. Convenience has value. Records matter. Credit systems matter. The intelligent approach is not total rejection. It is selective dependency. Use what is useful, reduce what is dangerous, separate convenience from critical resilience. That is the balance. I also want to say something about timing. I do not know whether the most visible stress arrives in April 2026. Exactly. Anyone who pretends to know exact dates with confidence is performing, not investing. What I do know is that preparation must happen before the acceleration, not during. You cannot diversify banking exposure gracefully in the middle of a run. You cannot build a Treasury ladder comfortably after the panic headline. You cannot suddenly become a patient liquid buyer after discovering you are trapped in the same channels everyone else is rushing to escape. All the intelligent moves are earlier moves. That is why the calendar matters psychologically, even if reality does not obey it perfectly. A deadline forces thought. The public rarely acts until thought becomes unavoidable. So if the phrase "before April 2026" causes households to finally examine their balances, functions, reserves, and institutional concentration, then the phrase has already done useful work. Because what destroys people is rarely ignorance alone. It is delayed recognition. The truth usually arrives long before action. I have no interest in telling decent savers fairy tales. The financial system is more leveraged, more interconnected, faster moving, and more confidence dependent than most depositors understand. That does not mean doom. It means structure matters, insurance matters, liquidity matters, direct ownership matters, short duration matters, hard assets can matter, written plans matter, and calm households with layered reserves will always live through stressful periods differently from households that trusted the logo on the branch more than the architecture of their own balance sheet. If I were reducing this whole subject to a handful of rules, I would make them plain. Never leave large uninsured balances sitting lazily, because dealing with them feels inconvenient. Never confuse legal coverage with practical readiness. Never rely on one channel for all essential liquidity. Always know how many months of true expenses you can cover without normal banking convenience. Always keep some immediately accessible reserve outside the usual path. Always understand what each account is for, instead of letting every dollar sit in one familiar bucket. Always remember that a crisis is hardest on the person who needs the system to work perfectly that exact week. And above all, never wait for public panic to begin private preparation. That is backward. Preparation must feel unnecessary when you do it right. That is the point. The day it feels obviously necessary is usually the day it becomes crowded, expensive, and clumsy. I have spent my life thinking about allocation discipline and the behavior of people under pressure. Pressure reveals what structure concealed. The family with no redundancy becomes a hostage to timing. The family with layered reserves becomes a chooser. I know which one I would rather be. So if you are asking me what I would withdraw from my bank before April 2026, my answer is not a theatrical all-or-nothing amount. My answer is this. Withdraw enough that your household can function calmly for 3 to 6 months without needing the banking system to be perfectly smooth. Then place that money intelligently, some in direct short-term treasuries, some in immediate cash, some, if appropriate, in hard asset insurance. The exact figure is personal. The principle is universal. Do not wait until the crowd asks whether the bank is safe. By then, the only people thinking clearly will be the ones who prepared while everyone else was still talking about something else.